Begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
All right, everyone, good morning. We're going to be starting here in a little bit, about 20 minutes, guys. But before we get the ball rolling today, I just want to make sure that my voice is coming in loud and clear. So for those of you that are attending, if you can just type a yes or give me some indication in your question box that you can hear me. Okay. Tim said it's kind of echoey. Let me try to. You're emailing mom, dad. Let me try to mess with it. Thank you. Yeah, thank you.
All right, I think I changed my headset, guys. Is that better? Perfect. All right. Excellent. Fantastic. Thank you for the feedback. We'll get going here in a little bit, guys. Really excited about today's event. So just bear with us. Victoria already asked, this is a webinar going to be recorded? Most likely, yes. We have to pass it through, compliance and review it at the end of this. But more than likely, yes. I would say 99.99% sure. Okay, so we'll be back with you guys in a little bit. Thank you. All right, looks like we got a bunch of people coming back in. So we're going to start right on time this morning in the next about 6 minutes, 7 minutes at 8:15 Central. Thanks again for coming to this morning's presentation. Just bear with us, guys. Going to start right on time. Thank you. E-Mining Mom is asking how long this presentation is going to be. Probably like around an hour, but Tim's going to be viewing live market data, so it's really it's really up to Tim and what's going on with the market. So just expect to be about an hour. We're probably going to record this webinar event, guys, but that doesn't mean that you should not fully attend today's presentation throughout the entire time frame. So once again, going to get going here in about 6 minutes. Thanks again for coming to today's event. Waiting for the stragglers, so we're going to start right on time in the next 6 minutes. Thanks, guys.
Mic check 1, 2.
Yeah, hey Tim, I can hear you.
Great, thanks, Marcus.
Yeah, you're welcome. All right, guys, so we're going to start right on time, as I promised you. Thanks for taking time this morning to come to this event that we're hosting here with Tim. We love doing these webinar presentations with Tim. Tim is going to be presenting here in a little bit, but before we get the ball rolling, guys, I want to go over something that is extremely important, and it is a risk disclosure. Now, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Now, you probably see this all the time. It's in the bottom of emails all over the place, and it is because it is important. Each and every one of you guys here at today's event has a representative at Infinity Futures, and you should only fund your trading account with risk capital. Now, my own personal definition of risk capital is money that you can afford to lose that won't change your current life or retirement horizon. Now, and each and every person is in a different financial position. We realize that. So if you guys are kind of curious what you believe to be your own amount of risk capital or risk exposure to the market, just let us know. Give us a call. We are known for our direct customer service and support, and we love answering questions. So honestly, the golden saying is there's no question that's dumb. It's true. Ask away. There's no point in this process of learning that you don't need some assistance. So we are there for support. Please ask away. You can always call the main line. You can email me directly, email your rep directly. I'm sure that you've probably been in communication with us in some form or another. So before I pass it over to Tim, I just want to pull up what we offer here at Infinity. And we are a futures brokerage. We've been in the industry for over 20 years now. And the large majority of individual traders use us for not only execution, but also for charting software. So we have a double combo. We have the Infinity Active Trader quote board and the depth of market screen, which I'm going to populate right here for you guys. So you can see, I'm sure you guys are accustomed to this. It's quote board, shows you the current market price, and then you can populate a dome or depth of market screen, 10 ticks deep, level 2, for each one of the markets that you'd like to trade. This is extremely functional, easy to use. We have a plethora of tutorials on our YouTube page. So if you don't want to initially, commit and get a demo up in front of you, we don't bill for it, by the way. All you got to do, if to really check us out, jump on our YouTube page. It's easy. Just go to youtube.com, type in Infinity Futures. We have a well-documented tutorial library of how this system operates. And then, of course, we also have charting software. We connect to various charts, but a large amount of our clientele base uses AT charts, which is just a white label version of Sierra charts. And here you go. Here is what Sierra AT charts looks like. It's really cool, guys. So we offer Sierra, their level 5 data tier with Infinity. It's already pre-connected to their data feed. We have embedded charts, including Tim's chart book file. So after this trading event, if you want to get what Tim is using, just let me know. Shoot me off an email. Your rep here, we can get it in your hands. And it's free if you execute 10 round trips on a 30-day business cycle. Now, if you already have a Sierra account, we offer their level 5 data for free with a little bit of trading. So, there's some financial incentive to make the transition to Infinity, even if you're already a Sierra chart user. And if you're not, I highly recommend just getting on a demo account. It's like test driving a free car. Who doesn't want to test drive a free car? Absolutely free. We probably already have your contact information. So it's not like you're giving us any a new piece of information, just name, email, phone number, and I can give you this demo account for free for 30 days. Then afterwards, if you want to make the decision, move forward, great. But if not, you at least have experienced what Infinity offers. So that's enough of my little spiel here. Tim, thanks for taking it out of your busy schedule. We always love doing these events with Tim. Yeah, I'll let you take it away, Tim.
Hey, thanks, Marcus.
Yep.
Thanks for tuning in, everyone, this morning. I'm going to go ahead and switch to my screen here.
Please do.
And the webinar will be recorded. Let me grab my screen. Change presenter. There we go. All right. So thanks for joining in the presentation this morning. We're going to talk about a whole lot of different aspects that go into trading, and sometimes, you know, we can move kind of quickly. I'll try my best to go through a little bit of structured material here first in the form of some presentation slides, and go through some good pieces of information that we can then use and apply to our trading. So what I'd like to do is talk a little bit about tick charts, Heikin candlesticks, Fibonacci retracements, how I use them in my trading, how they apply to the futures markets, how you can start using them right away, and then we'll try and jump into you know, the live market here and look at the charts and the Infinity platform, and I'll do my best here to answer questions as we go, but I'll also try and save some time at the end, and I'll have my email up there too if you want to follow up and continue the conversation. So thanks for tuning into the webinar this morning. My name is Tim Reset, and I blog and have a website over at emoneymind.com. I've been working with Marcus here, doing these webinars and live trading sessions for a long time, and I really enjoy Marcus and the guys at Infinity. So today we're going to talk specifically about capturing moves in the futures markets, and the tools that I use to do that are primarily tick charts, Heikin candlesticks, and Fibonacci retracements. I recognize a handful of names in the room, but if you're new, well, before we get to that, let's just kind of summarize what we'll talk about today. Again, you know, there's a lot of different ways to look at the markets. There's a lot of different ways to look at price, to interpret price, and to kind of use the chart to give us low risk entry points. So we'll talk about why, you know, I think tick charts and Heikin candlesticks are a great tool. We'll talk about, you know, how we can identify the change in momentum very quickly so that we can be getting into a trade, you know, at the earliest sign of momentum change rather than kind of being late to the party. And then we'll talk about how you can get into a trade and actually stay in a trade, you know, for longer than just a couple of ticks, and actually capitalize on, you know, this process and these tools that we're using. So for those that are new to the trading world or haven't had the opportunity to chat with before, again, my name is Tim Reset, and I've been trading since about 2006. I'm a Chicagoland native, now currently living in Arizona, and I got my start trading stocks, swing trading stocks, and then I moved over to options, and then shortly after, in about late 2008, mid 2008, I moved over to futures trading, and I got started with Infinity. And they're a Chicago-based firm. Got started with those guys and been with Infinity ever since. So it's been fun to be a part of a growing industry in terms of the electronic trading world. When I got my start, I was down in the trading pits, just kind of meeting with. I had a friend who had an uncle down at the Chicago Board of Trade, and we'd go down there, and they would always tell us, you kids don't want to be. You don't want to make a career down in the trading pits because this is dying. Our pits are shrinking. A lot of the guys had computer terminals around the pits, and they would just look at the charts and then go into the pits to place their trades. So it wasn't long after we kind of got exposed to the markets in that way that we started our futures and stock and option trading on the computer, and they hooked us up with some really just incredibly smart traders who had been trading on the screen since the late 80s. And so to have a mentor like that and a couple people that were able to kind of coach us along as young kids, I say young kids, but college age kids 12, 13 years ago was super beneficial. So this progression that we go through as traders is something that it's a process, and whether you're new to trading, whether you've been trading for a long time, whether you're in a groove, or whether you're kind of on an up and down roller coaster, there's always something that you can take from every single trading session, and we'll talk about some of those today. I've been a speaker at a number of the Traders Expos, looking forward to Chicago this summer. I've never spoke at the Chicago Traders Expo, and it's a fairly new one. So I'll be out there in July, and I hope to see some of you folks there. Always fun to meet people in person, after chatting via email and over some, one-on-one conference calls and things like that. So I'm also a mountain biker and an ASU Sun Devil. Graduated from ASU, and when I'm not in front of the computer, which I try not to be all day long, I like to get outside and explore, hike, ride my mountain bike. I do quite a bit of mountain bike racing, and so I find that the more I get away from the screen, the better my trading becomes. And so it's important to be able to be super focused, and when you're in front of the screen trading, you have a reason for being there. But then when the markets close, or when you're outside of your execution window, if you're only going to focus on a certain time frame during the day, in order to be super focused on those couple of hours or during that session, it's really important to get away from the trading screen so that you can refresh and let your mind kind of process what you're working on, this puzzle that we're working on in the markets. So yes, Mike, I am very familiar with the risks associated with mountain biking. I actually had my first serious injury in January, and I fractured my hip. Not doing anything wild and crazy, but yeah, last January I did that, and luckily it was a pretty short recovery. I didn't have to have any major surgery, but calculated risks are what it's all about, just as with trading, just as with starting your own business, purchasing a franchise, doing any kind of anything in life, really, getting in your car and going for a drive. All of these things we sometimes take for granted in terms of the risks that go along with them. So that's kind of a little bit about me and my background and where I've come from to get to this point. Again, the process of developing the mindset that you need to become a sound and what a lot of people would consider successful trader is a lot different than a successful real estate broker or some other business person. There's a lot more up and down that can occur than in some other industries. So it's so much more about having the right mindset going into trading than it is about having the one specific tool that's gonna make you as a trader. So let's kind of go through some of the mechanics here, talk about these specific tools that I use, and then we'll go take a look at some examples. So let's just first start with a tick chart. And a tick chart is essentially a different way to look at the prices in the market. And you can just think of it, instead of a 5-minute chart or a 30-minute chart, you're looking at a different time frame, and this time frame is based on the number of transactions. So instead of 1 minute of time passing, we have a number of transactions that occur, and then the candle closes. That's really how the chart is being displayed. So when you get a faster forming chart, when the bars are closing quicker, that just means that more transactions are happening, and thus you're kind of getting more volume. And so it's a good way to get a read on the market because you have so much built into that specific bar, and it's directly derived from price. So you'll notice in this example here, there's really as I take away the x-axis, it looks like a normal chart. This could be a 1-minute chart, a daily chart. It could also be a tick chart. So the chart itself doesn't look different. It's just the way that the bar is compiled. So when the next tool that I use is the Heikin candlestick, and we'll break these down all three, and then we'll combine them together. So the Heikin candlestick, if we go back to this chart here, we have what is very commonly used, a candlestick bar. So we've got bar charts, we've got line charts, all kinds of different ways to view price. But the candlestick using the open, high, low, close, and depicting whether or not the actual bar was positive or declining, bullish or bearish, is determined by the actual fill of the candle. So a Heikin candlestick is just a variation of the traditional candlestick. So it's very similar, and let's look at two side by side. So we've got the traditional candlestick on the left, and the difference, instead of each bar starting with the open price, so a new candle forms, a traditional candlestick, you would start with the opening price of at that time. Well, the Heikin candlestick just starts from the midpoint of the previous candle. So the left being the traditional candlestick, the right being the Heikin candlestick. And what that gives you is this string of price in one direction and then a string of price in another direction. So if I bring in my chart here real quick, here's another example of the traditional candlestick on the left. You can see the traditional green and red bars, and then the Heikin candlestick on the right. And you'll notice that you get a little bit more, it's easier to see the trend. You get a little bit more color trending. So yeah, we can look at the chart here on the left and say, okay, yep, well, this section, here's a downtrend, and then here's a sideways trend, and here's an uptrend. But when we come over to the Heikin candlestick, it really gets clear with the way that price starts from the midpoint it really helps our eyes see the trend, and then as the market is developing right here, see the change in trend. And we can very clearly see, okay, we've got the string of red bars, one little green bar here, but then now all of a sudden we're going into this stronger string of green bars. So when I'm looking at my trading screen, the idea is to train our eyes so that we can become accustomed to the inputs that are coming at us. And then what is a conscious exercise then becomes subconscious. Yeah, good question, Chris. I don't pay much attention to the wicks or the actual shape or body of the Heikin candlestick. I'm really just concerned with the trend. David mentions Renko bars. There's other bars and patterns that you can use aside from the traditional candlestick, the Heikin candlestick. The Renko charts, different platforms have different charts. Now, something like the Heikin is pretty common on most platforms. And like Marcus said, I've got the chart book set up for my tick chart in the AT Infinity AT chart. So I've got the Heikin and the tick charts already in there, and I can kind of walk through how I set that up as well. So the color bars help give us kind of a direction and train our eyes so that we can spot not just the trend, but more importantly, the trend changes. And that helps make things a little bit more obvious. And then the more we can focus in on one market and one time frame, like the 512 tick chart, which is what I like to use to place my trades, then it really helps us get in a pattern. And so even if you're only trading, Tuesday, Wednesday, Thursday for a couple hours in the morning, you get in this habit or this pattern of looking at the same market on the same time frame, and you start to pick up on different nuances or little things that you're seeing throughout the day, and then you can use those inputs, that data, to help place your trades. So Elizabeth asks a good question: how do we recognize a change in trend? And that's exactly where we're going next. So when we combine the 512 tick chart with the Heikin candlestick study, like I said, it gives you a good representation visually, and it helps us identify the trend changes. And so if we look at, again, a side-by-side traditional candlestick with the Heikin candlestick, a couple things that I look for are the continuation of a string of candles. So over here on the left, yeah, again, you can kind of see, okay, we've got a downtrend and then a sideways trend, and then the downtrend continues. Well, on the Heikin candlestick, when we go into this sideways trend, it's very clear when the trend is forming. We go from this string of consistent red bars all of a sudden to just 3 or 4 green bars, and then a couple of red bars, and then a couple of green bars. And so when we have these periods of back and forth of red, green, it could be in the context of a sideways consolidation, or it could just be the market opens, and in the first 5, 6, 7 minutes, things are a little bit, back and forth, as opposed to the market opening and developing a consistent run or a trend off the open. And so when we go from, anytime we go from a, trending environment where we have a direction to a non-trending environment where we have a consolidation or a range or perhaps some sort of triangle or wedge forming, you'll see the candles begin to change back and forth more quickly. So in terms of, sometimes we'll get one candle or two candles in the mix of a trend. And I like to see a little bit more than that. So let's say we just had one green candle in this move down. That wouldn't be as strong as having all red candles, but one green candle is a lot different than having, a whole period of say 15, 20 minutes where it's just a couple bars in one direction and then a couple bars in the other direction. And having the Heikin Ashi helps this chop, helps your eyes see the formation of that chop a little bit quicker. And the sooner we can identify that the trend is going from down to sideways, or perhaps, as we've seen a fair bit lately, sometimes we'll just go straight down and then form this V and go straight back up. That ends up becoming more visually apparent. So when it comes to identifying the trend, that's sort of the first job that we have to do, and then the second step is looking for trade setups. So we know that the market's made up of waves, of these strings of green and red bars or black and white bars. The market will move up and then it'll pull back, and we know that it just doesn't go straight up with no sort of undulation or pullbacks. And so as individual traders, we want to be able to get into a trade and sort of be in for the meat of the trade. It's very, very difficult to consistently pick tops and pick bottoms. And so if we can identify an area that the trend is changing, which as we take a step back, we first have to identify the trend, then we can be an early adopter into that trend change. So all of the activity that we're seeing on the chart is being driven by human behavior. So it's important to remember that even if there are algorithms and all of these computerized trading programs out there, it's all being driven by the human factor, those emotions, fear and greed, and the individual nature and the biases that are inside of us. So when I talk about developing that mindset, a big part of that is being able to detach ourselves from our innate biases and tendencies that are already within us, that we're hardwired. And so the more you do something, but more importantly, the more you do something and practice something correctly, the better you can begin to train your mind. And the first thing that you have to be able to do is make a conscious observation. It's okay to have a thought of, ooh, I'm in this trade, and maybe I should get out here. Things are looking a little bit. I don't know if this trade's going to go or turn around on me. It's okay to have these wonderings and these thoughts. Should I move my stop to break even? Oh, I'm up 2 points on the trade, and I had a losing trade earlier. Maybe I should just get out. It's okay to have those thoughts, but it's not okay to act on those emotions. And so whether you just make a note or jot down a thought that you're having, or something that you're observing, we want to have a process for our decision making, and that process doesn't involve snap quick decisions or impulsive decisions based on our emotions. So when we talk about a trend, we've got uptrend, this very simply higher highs and higher lows, something that we can pick out on the chart, lower lows and lower highs for a downtrend. And then we have situations where, there's not really any trend, and we've got a mix of the two, market making higher highs as well as lower lows. And so just by printing out your chart, whatever market you're trading, it could be a 5-minute chart for the day, and just going through and marking the highs, marking the lows, and how they relate to the previous high and low is a very, very helpful exercise. So let's talk about getting into the trade. So after we've identified the larger trend, then we can start to look for places that the trend might be changing. And so what I like to do to get into a trade is wait for one of those highs or lows that we just identified. If I go back to the chart here. So first, if I'm identifying the swing highs and the swing lows, waiting for one of these to break. So if we're moving higher, moving up in higher highs, up in higher lows, market is in an uptrend. If we wait for the trend to break a swing low, then we have an opportunity to get into what could be the start of a new trend. And so waiting for that break of the swing high and low first. Here's another example of it. We've got a high put in, and sometimes we break a swing low, and we may be in an uptrend, and we break a low, and it's a sign that, okay, the uptrend might be coming to an end, and here's an opportunity to get into a short. In another situation, sort of a continuation of the trend, we are putting in higher highs and higher lows, and we simply break the previous swing high. And it's a sign that, okay, we're continuing on this trend of higher highs and higher lows. And waiting for a pullback to get in is where I like to look for my actual entry. So whether it's a long or a short, rather than trying to chase the market higher or chase it down, I like to begin by identifying the trend and then wait for a pullback to get into that trend. Or if the trend is changing, if we were in that string of higher highs and higher lows and we break one of the swing lows, now we have an opportunity to get into a new trend on a pullback. So I just use a very simple Fibonacci 50% retracement, and that's, essentially it's just giving, whether you believe in Fibonacci's or believe in technical analysis, is kind of irrelevant. All we're really looking to do is get into a trade when the market has taken a little bit of a breather, rather than chase the market, get in a trade as the market's making new highs, getting long, having profits being taken from traders who were in earlier than you, and then having the market retrace, pull back, and then getting stopped out of the trade. I'd rather be a little bit more patient, let the market pull back, kind of get in when not so many people are looking, and then be in the trade when the market breaks out again, and then being the one to be leaving the trade, taking profits as those chasers are coming in. So swing high and swing low break, letting the market pull back to the 50% retracement, and then getting in the trade there on the pullback, and then trying to simply ride it out or trail my stop and stay in the trade as long as I can. So how do you do that? I talk to a lot of traders who kind of have a grasp of the markets and can spot good trade entries, and they get into a trade and they don't have any problem accepting the risk that they're putting on, but then the market moves 2 ticks in their favor, or they're taking a couple of ticks of heat, or the market is just moving slow and it's kind of just chopping around at your entry, and they want to get out right away as soon as they're up a point. And if that's you, one of the things you can do to combat that is to really make an effort to, if you're just trading one contract, to put a target out there that's 2 times or ideally 3 times your risk. So if you're using, like I use a 6 tick stop on the ES, for example, which is very small. Well, if you just put a target out at 12 ticks or 18 ticks, and once you're in a trade, you either let it go to your stop or let it go to your target, and you can physically sit on your hands if you need to, or minimize your trade ladder if you need to. It's a very good practice to develop the habit of letting the trade work itself out. And sure, some trades might go 8 ticks in your favor or 10 ticks and then reverse and come all the way back to your stop. But the idea is not to introduce too much at once. So once you can get in the habit of letting the trade work itself out, then we can start doing things like having a target and tightening our stop from the bottom, so that when you're up 2 points on a trade, then your stop might be at break even. You don't want a 3, 4, 5 point winning trade to come back and turn into a loser. But it all starts with creating these good habits and structure for us to execute off of. Kelly, there's definitely markets that are better than others. Markets like the ES, the YM, the NQ are all very, very good markets. The YM can have a little bit of jumping around because the way that it's structured in points, and the trade ladder can move very quickly sometimes. But then on the flip side, the ES being 12.5 dollars per tick can be a little big for some. So the NQ is a good kind of middle spot. And no, David, I don't like to scalp just for a few ticks. It really becomes difficult, and especially in the last 10 years, to be scalping for a couple of ticks and trying to compete with the big trading, computerized hedge funds and firms out there. The market's got to trade through your price to get a fill in real time. And so you already need, a tick on one side to get the fill, a tick on the other side to get the fill to exit. And if the market moves 2 ticks, that's a point. Well, if I'm risking 6 ticks, I don't want to just take 2 ticks, because then I have a situation where I have to have such a high win rate to overcome one loser. So what I'd rather do is spend the time getting in the trade, identifying the trend, number 1, identifying where the trend might be changing or continuing as step 2, getting in the trade as step 3, and then staying in the trade by trailing my stop. And so a couple of the methods that I use to do this are, well, let me just first say they both stem from the price and the chart. So rather than using just an arbitrary, let's say a 2-point trail stop, so if the market moves up 2 points, my stop stays 2 points behind me, and then it goes up another tick, and then the stop moves up a tick. What I'd rather do is use one of these 2 options by either trailing swing lows. And what I mean by that is just the low, one tick below the previous swing low. So the market kind of pulls back and then makes a new high. And you can just put your stop underneath the swing low there. And then when it pulls back again and makes a new high, then you just move your stop up underneath the next swing low. And that way, when you do get stopped out, you're getting stopped out for a profit, and it's the market telling you, okay, we have potentially a trend change here or a change in momentum. So the the market's getting you out, and then it's a little bit easier psychologically to kind of take that as opposed to just using an arbitrary number as your trail stop. The other thing you can do when the market is moving really, really fast, as it will do sometimes, rather than have your stop all the way down here at this first white bar and have the market be 4 points above you, trailing each candle's low just by a tick or two. So the new candle forms, and you just move your stop up underneath the previous candle by 2 ticks. And just keep doing that until the market breaks the previous candle and then takes you out. And when the market's moving really fast, you can have a tendency to just kind of freeze up or go into panic mode and maybe hit the flatten button or just close out of the trade. But rather than do that, I'd rather just be more aggressive with my trail stop. And sure, I might be moving my stop every 30 seconds, but at least when the market takes me out of the trade, it's the market telling me to get out as opposed to me imposing on the market. So to kind of tie this all together, the tick chart and the Heikin Ashi combination are really helping give us the visual cues that we need to, 1, identify the trend, 2, identify where the trend is changing, and then we can look for trade entries when the market does break one of those swing highs or swing lows. So just like I said, identify the trend, the change in trend, and then we want to be entering at either the start of a new trend or the continuation of a trend, but as long as we're not chasing the market at highs and lows. Sure, there's some instances where getting in on a breakout or a breakdown has its place, but it's all in the context of the trend itself. So again, using a simple 50% retracement tool to find those places where I want to enter. And then when it comes to the trade management side of things, just trailing my stop, if the only thing you do differently or look to incorporate in your trading is to trail your stop, that can do wonders for your trading. Even if you kind of saying, well, I really like using my 5-minute bars and I'm comfortable with my entries and I don't really have a problem placing trades. My challenge is just I get out of the trade and then I come back 20 minutes later and the thing had I stayed in, it's way above where it was and I would have had this big winner. So if you can just adopt a trail stop approach, either by one of the options that I outlined, trailing swing lows or swing highs, trailing each candle, you could even trail the 61/8 of the fib retracement if you want. There's lots of different ways to go about it. I find that the trailing of swing highs and swing lows is the best in terms of all the trading that I've done. That's the same approach that I take with my swing trading when I'm using a daily candle. And so all I did was apply that, and I shrunk it down to the day trading time frame. So you can use those techniques across different markets, different time frames, and it becomes really helpful in taking out some of that emotion of the subjectivity kind of that we drive into the decision-making process. So that's really the best way I found to kind of detach from some of those emotions of fear, detaching yourself from the dollar factor. So what I'd like to do now is just kind of, I'm going to bring my chart back over here and talk about a few things here in as it pertains to this morning. I know I missed a handful of questions in the mix there. The webinar, again, yeah, is being recorded, and I know we kind of go quickly through some things, and reviewing that material is really helpful. And thinking on something, and then like I said, getting outside or getting away from the screen is when you can really take those conscious thoughts and then turn them into subconscious. So just got a very simple ES chart here. On the left, I've got the 5-minute, and then on the right, I've got the tick chart, the 512 tick chart with the Heikin Ashi candlestick. And so right away you can see, yeah, there's some similarities, but there's definitely a difference here on the tick chart. And right off the bat, if we start with the 5-minute chart, we're about 30 minutes into the trading day this morning. You probably know that the last this week has been a little bit strange, or maybe some of it you have found a little bit challenging to trade. If we just look at the 5-minute here, the open, just starting where this increased volume occurred, you can see these longer tails on these traditional candlesticks, and that does make for a very challenging trading environment because you have selling and then buyers coming back in, and then the very next candle, boom, selling, breaks the previous candle's low, and then the buyers come back in and push us back up almost to where we were at the previous bar. And then the next candle, it just kind of does it again, selling, and then the buyers come back in and push it back up. So, we can see that this maybe 26.47 area, 48s, was acting as some support. So even without drawing lines on the chart and fib retracements, you'll notice I don't have any indicators, quote unquote, on the chart. You can really determine or pull out a lot of information just from the candle itself and the chart itself. So keeping a clean chart is really helpful to have a clean mind and have a strong foundation to work off of throughout the day. If you got 50 different lines on your chart, they can clutter your decision-making process. So this week, what we've had is a lot of back and forth, kind of whipsaw price action. If I go to a daily here, we can see the bottoming tail, yesterday's bigger hammer formation, and then today, notice we have this downtrend back here, and then the sideways trend, the uptrend, another downtrend, and now what are we doing? We're breaking the previous day's high right now this morning. And so this would be the start, or the potential start, of a new trend to the upside. So that's kind of the daily context. And again, just looking at the 5-minute chart looks a lot different than the Heikin Ashi with the 512 here on the right. So if I'm going to make this chart larger, and as I just kind of scroll back this morning, we can see just kind of a snapshot this morning. We've got a few candles in the in the red direction and then in the green direction, kind of a mix here in the first 15, 20 minutes. So not a very strong trend right off the open. As we get a little bit further, actually pre-market. Let's go to right here. There's our open. So again, it got kind of the pre-market, also the same sentiment where we have not a lot of trending going on in the first 20 minutes. We can clearly see that, if I drew a horizontal line, that the trend is not really there. We're moving sideways, but it's also depicted in the chart itself with just a few bars in one direction and then a few bars in the other direction. And even within that, though, we can see that we're starting to get a little bit of string together of red and green. But if we come back to those swing highs and swing lows that I was talking about, we can just start the day off here over on the left and say, okay, we have got a high that started the morning, and then down here is a low, and then we bounced, put in a lower high. This high here is lower than the previous one. And then moving forward, we have a lower low. And you can just kind of go through that. And as we move into the day, we get into these situations where we have a high and low that just encompasses, a 45 up to a 50, so a 5-point range. And all of this trading is taking place inside of that range. So the first 15, 20 minutes of the day today, not very exciting. There's not a lot of opportunity. I don't trade in the first 15 minutes. I just watch, let the market kind of digest what's been going on, and then jump in after that. But now as we move forward here, now all of a sudden, okay, yep, open a little bit choppy, range bound. As we move forward, now we can start to see, okay, well, here's the top of that range earlier, the two candles, or just a little high and low that was encompassing about 10 minutes of the morning. And then now, what do we have? We broke out of that range. And so that's just a sign that, okay, there could be some trending to the upside here. And now as we start to move further into the morning, I mean, just look at the difference here in the next, the first 20 minutes versus the second 20 minutes of the day. Now we have these strings of green candles, this little bit of a pullback, and then another 10, 15, 20 candles that are all strung together in a nice color-coded trend. Now, after a while, you begin to be able to see the trends with and without the Heikin Ashi. But the idea, again, is to train our eyes, train our brains, so that we can spot these movements. And now we have some pretty clear swing highs and swing lows. We've put in a new high on the day compared to the opening price. And so if we were to kind of come back and look for an opportunity, okay, here's the it's only one candle, but it's the swing low prior to what I would call the breakout this morning. So here's a series of three, a triple bottom, if you want to call it that, triple bottom, all priced at the same level. Notice how this high here is a little higher than this previous high, and then this low is a little higher than the previous low. So as we go through, even though the market was moving sideways in this range here, we can start to see potential uptrend forming in the range between 45s and 50s. So as we move forward through that, start to see, okay, higher high, higher low, higher high, higher low. Oops, here's a breakout. So then we can start to, continue drawing up the retracements from just always going from the left to the right and starting with, a swing low to a swing high, and then letting the market pull back into the 50% retracement, getting in just in front of the 50% retracement, and then riding it as long as possible. I will use the negative 23% target as my first exit point. So if you've got two contracts, just getting out of one at the negative 23 and then trailing the second. And if you've got 4 or 3 or any multiples, you can split it up 3 and 3 or anything like that. If you've got one contract, it's really helpful to develop as a trader to get out of the trade at a target. But you could trail. You just want to use the same method every single time. So if you're going to get out at the negative 23 with one contract, you got to trade that way all the time. If you're going to trail, you have to trail your stop every single time. Other way, you get in the situation where the market will go to a target and you were trailing, or you trail and got out at the target and then the market kept running, and then you're just kind of on the back side of the trade every single time. When I'm entering, I'm always putting my order a tick or rounding up and adding a tick in front of the 50% retracement. Now you'll notice, obviously not every single time the market is going to go make a full retracement, and you can chalk that up to a strengthening market. And then there's other times where the market may go into the 50% retracement and beyond that a little bit more. But using it as a framework, we come back a little bit to yesterday. Using it as a framework to place trades, and you can see the swings here, and notice how once we break, here's a high here, and then we kind of move sideways. We put in a lower high, lower low, lower high. Oh, we have a higher low, and then this high is higher than both this one and this one. So drawing from lows to highs, letting the market pull back. Even if it does come into the 50 a little bit, that's okay. Notice how the market is rounding out here, and then riding that from the 50% up to the negative 23% target, and then trailing your stop underneath the swing lows at the same time, and riding that out as long as possible. It's that process of just methodically going through the chart and looking for swing low, swing high, no matter how big or small it is, drawing from the left to the right, letting the market pull back into the 50, and then riding out the trade as long as possible. So again, even if you're not using retracements to place your orders, maybe you're just looking at support and resistance, and you're saying, okay, well, this this line here was a nice resistance spot. It was the top of the range earlier this morning. And so as we come over here, I'm going to look for a long entry, somewhere around that previous resistance, which now should act as support. So you draw your line and you say, okay, 26.50, 50. Well, if price just touches that, it's not going to fill me. So I'm going to put my order, I'm just going to use the limit order, put it out there at 26.50, 75. or 26.51s. You place your order and you get in a trade. Well, it's great to have a stop that goes out, but what are you going to do if the trade goes your way? And if the market just starts moving higher and you have no plan, then you may just hit the flatten button or close out of the trade with just not really having any sort of reason for doing so. But at the very least, if you trail each candle's low here on the way up, you're just trailing by 2 ticks, and eventually the market's going to break a low. But look where you're at. If you're getting into the 51, and this is already 57s. If you wanted to trail swing lows, I would just be trailing, having my initial stop down here. The market makes a big run up. Maybe you have 2 contracts and you take, you use a 6-tick stop. You take one off at 3 points, and then your second contract, now you're kind of playing with house money, if you will, and you let the market pull back. And once it makes a new high, then you can take your stop and move it up underneath that swing low. Market makes a high, pulls back, makes a new high, next swing low, until, oh, what do we have? A potential trend change. Market breaks the swing low, gets you out of the trade. So just having that methodical process is very helpful. In terms of what to do when we have this uptrend here, but then we also have this potential start of a downtrend, what I like to do is kind of come back and draw, make a full retracement to see where the larger retracement, where the market may pull back to. And what do you know? Hey, this kind of previous consolidation is where the 50% lines up with. But then we can also draw up a short. And depending on how strong we deem the uptrend to be, riding a short down into a long, or waiting for the market to pull back all the way into the long, and then taking a setup off of that larger level is also a good approach. So we can take shorts in the context, as a counter trend, sort of shorting at highs or getting long at lows. Those are completely valid places to get into the market. You can also wait for the market to make a bigger pullback, and then when it does, if we see a pause or a consolidation at a bigger support level, then we can draw up another retracement on the 512 tick chart and get into a trade in the direction of that original trend, which currently we have this larger uptrend. So letting the market pull back and then getting in to a long is a great way to get into the trend without feeling the need of chasing the trend. So as we kind of wrap things up and put all the pieces together, if you will, I always like to kind of close with the importance of the screen time and actually being in front of the charts, watching the charts, whether you're on a demo account trading or just observing, maybe jotting down, okay, here's an entry at 9:12, here I would exit at 9:30, yada yada yada. But working smart and being diligent and focused is what helps build that discipline. And just like a professional athlete would look for little things that they can tweak based on, if you're shooting free throws, you kind of, okay, I'm missing to the left, well, let me move my elbow over, let me move my wrist, and make these little tweaks and constantly be making improvements. That's what we want to do, and constantly be just sort of have a general idea of where the ship is pointed, but during the process we just kind of have to turn slightly and make little adjustments. But if we're not focused, if we're just sort of sitting in front of the screen all day, have one eye on the markets and one eye on, the interwebs, then it's going to be a lot harder to improve and grow. So a lot of good stuff over at eminimind.com. I've got lots of information on my kind of mindset, the trading rules that I use, my trading strategies for the ES, for a lot of the futures markets, and again, all of these Heikin, Ashi, tick charts, Fibonacci retracements, they can be applied to any market, any time frame. So the idea with the blog is to kind of help you develop the foundation and the mindset, and just kind of walk through a lot of my thought process. So lots of good free stuff over there. You can check that out. You can download a copy of my trading rules if you want to go through those. And it's just a really good way for me to kind of methodically think through ideas and express them in writing, and then be able to engage with other traders and kind of grow as a collective group. So that's right, Mike. Simplicity is it's all about being simple, keeping it simple. And if you have questions of regard to trading, you can email me your questions regard to anything really. Tim@eminimind.com. If you have questions about the Infinity platform, you can shoot an email over to Marcus or myself, and I can take a look at that for you. And it's trading is a very interesting endeavor. Like I said at the start, it's a lot different than any other business venture out there, and it all starts with the mindset. So keep your focus and really have constraints on when you're going to be trading and when you're not going to be trading, because there's so many markets out there. You can become consumed with being in front of your computer all day long, and it can really drive you in the ground. But if you're focused and you work smart and you develop that discipline and you develop that patience, then you can really grow and make progress in your trading. So I want to thank everyone for tuning in this morning. And again, my email there on the screen, tim@eminimind.com. Happy to chat more. Go over to eminimind and check out all the resources there and the free content. And if you have questions, shoot me an email. Thanks, everyone, and have a great rest of your day.
All right, thanks, Tim, so much for taking the time out of your extremely busy schedule to do these presentations with us. Always look forward to it. Always great amount of depth and information that you send our way. So thanks once again. I'm just going to go ahead and change the screen over here, guys. Looks like we're okay, so once again, if you wanted to go to Tim's website, it's www.eminimind.com. He has a wealth of free information on that website, so feel free to do that. Once again, if you are interested in viewing what Tim populated, which was the Infinity Active Trader charting software, which is based off of Sierra charts, along with Infinity AT Dome, but you don't want to commit anything, any amount of time initially, you just want to check out some videos, please go to our YouTube page. It's an excellent archive of information, 1-minute segments that shows you how to create custom indicators to place in a regular trade on a dome, and gives you a visual representation of what we can offer here at Infinity. But once again, if you are interested in viewing this product, I know that probably there's a lot of people in this event. Tim normally brings a large audience, and a lot of individuals do not currently have Infinity accounts. We realize that, but there is no sense in not at least viewing other products on the market. It's totally free. Our software is a separate instance of programming, so it's not going to interfere with your current platform or setup. It's a separate instance of program, the C drive. I don't know that some of your developers might realize that since it's not a program file, that gives you a little bit of an advantage as well. Yeah, so if you have any questions, let us know. There's nothing that should be holding you back from jumping on a demo and really giving this a go, or at least checking it out, seeing what else is available on the market. I know that might seem a little bit overwhelming at first to understand a new platform, but the transition phase, it's relatively short with the amount of support we offer here, and then also with our tutorials. And we love helping you guys out. So don't hesitate to get in contact with your representative here at Infinity. But before we get going here, guys, again, I appreciate your attendance. I want to go over a risk disclosure. Trading futures, options on futures, and retail off exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Now, I'll go through. I had a couple questions here. I know that you guys are saying that this webinar is over. I got to go back, do my trading, or go about my day. But there was just a couple questions on the cost of the charting software. It is free. So we offer Sierra Level 5 data for free if you incur 10 round trips on a 30-day business cycle. It's an excellent offer. Sierra normally, if you went through them directly with the various data feed, it ends up being $60+ more a month. We give it to you for free if you just do a little bit of trading. We also, let me see, they have some questions here. All right. Oh, with the tick chart and the compatibility. Yeah, so Tim has a pre-loaded chart book within our charting software. It's really easy to populate. If you want to get that in your hands, just contact your rep over here at Infinity. He can walk you through the process. It'll take not only 5 seconds to do. All right, so good stuff, good stuff. Everyone's saying thanks to Tim. Can see that. All right, so we're gonna call it a day, guys. It is 9/27, April 26th. Great day outside. Everyone's really excited for the spring weather to finally turn the corner here in Chicago. So if you guys are ever in town, swing by the Infinity office. We're located downtown Chicago. My direct line, if you want to give me a call too, I will be posted up here. But appreciate it, guys. Have an excellent, productive rest of the week. And we appreciate it. Oh, Kelly, this here for the profile. Yes, we do, Kelly. That's the level 5 tier of that's the level 5 tier of data that we offer through Sierra for free. So Kelly, if you are interested in that, I'll send you an email with a download link, and then you can get profile, volume number bars, all the internal stuff that you're accustomed to for free. And we don't charge extra for that service, which is a fantastic offer if you ask me. Cool. All right, I think we're good, guys. No last minute questions coming in. All right, I'm going to get a cup of coffee here. And once again, thanks for attending. Appreciate it, guys.